So you realize that stablecoins collectively are the 12th largest holder of U.S. Treasuries. They own twice as much as Germany, for instance. The U.S. government does, in fact, want stablecoins to proliferate because it's a guaranteed long. Stablecoins never have declining assets of U.S. Treasury markets. And dollar dominance is only 27% in GDP terms. It's 88% in traditional financial market trading. 80%. It's 100% of the quoted pair in crypto. Dollar dominance is stronger in crypto. Stablecoin usage is only 20% in the U.S. Almost 60% of stablecoins trading takes place in Hong Kong, China, and Japan. So you can see that it's creating more demand for dollars outside the U.S.
And then therefore, Bitcoin will continue to go up?
Yeah, because Bitcoin secures the entire blockchain.
We're entering a financial revolution, not led by central banks or Wall Street, but by unstoppable code and open networks. The next decade won't just be about Bitcoin's price action. It will be about Bitcoin's utility and how it becomes the silent foundation for a new global financial system. According to Fundstrat's Tom Lee, we're on the cusp of exponential growth, not just in market cap, but in real-world use cases that tie Bitcoin and stablecoins directly into the bloodstream of global commerce. Think about this. Stablecoins are no longer just crypto sidekicks. They're turning into the killer app of Web3. These dollar-backed assets now move billions without middlemen, create profit margins that rival top-tier banks, and operate with the transparency of blockchain trust, not corporate opaqueness. Tether alone is reportedly more profitable than nearly every U.S. financial institution. And here's the twist. This entire ecosystem only works because Bitcoin secures it from the bottom up. Governments are starting to notice, not to ban it, but to embrace it. Stablecoins already hold more U.S. treasuries than countries like Germany. That's not a glitch. It's a strategic advantage. The U.S. dollar may only represent 27% of global GDP, but in crypto, it's 100% of trading pairs. And stablecoins are driving that dominance even deeper into Asia, where nearly 60% of stablecoin activity now takes place. The dollar is winning a new kind of war, one fought not with tanks or treaties, but with tokenized trust. Tom Lee makes it clear, this isn't just bullish, it's historic. As corporations like Amazon and Walmart explore launching their own stablecoins and banks wake up to the profitability of blockchain-based finance, Bitcoin becomes the anchor asset of an entirely new monetary regime. The institutions are coming, not to compete with crypto, but to build on it. And if you understand what's happening now, you're ahead of the curve. Because this next wave won't just reward the early adopters, it will redefine what we call money. Before we dive in, if you believe the future of money is being written right now on the blockchain, smash that like button, subscribe, and turn on notifications. This channel brings you expert insights from the minds shaping the next financial era. And today, we're breaking down why Tom Lee says stablecoins and Bitcoin aren't just disrupting banks, they're replacing them.
I think Bitcoin's utility is going to go up exponentially in the next 10 years. So one of the reasons Bitcoin has risen to 100,000 is just simple network value. When we first wrote about Bitcoin in 2017, and Bitcoin was under 1,000, we had said it could get to 25,000 by 2022 because it's a network value asset. So we just said, if you model number of wallets and activity per wallet, which explained 90% of the move of Bitcoin from 2009 to 2017, you would get to 25,000, 2022, and you can get to the six figures later. And that's true. It's still like 87% explained by those two variables. But Bitcoin is now about to become a lot more useful for two reasons. One is it's becoming less regulatory burdened, right? The White House is really creating it as a strategic reserve asset. And companies are putting it on their balance sheet because it's the way people used to have real estate owned in retail. Like that wasn't a thing, but then people realized it was valuable to own the real estate. Like some retailers are more valuable because they own the building. That's what Bitcoin is, your working capital is. And then, but banks are also quite interested in Bitcoin because of stablecoins. So stablecoins might be the Web3 app that's really recreating financial services because one, a stablecoin works better than a regular dollar.
You don't have to send it through middlemen to transfer
Yeah,
it.
that's right. Now, if you want to move billions and trillions, you just use the stablecoin market, and it's proving to be more profitable for a bank. Circle, like I won't comment its valuation, but as a net income, or Tether is a better example because it's
But
not
how do
public.
you trust those Tether people? Like, you don't really know what's going on.
Well, that's
behind the
where.
scenes.
See, this is where blockchain comes in. Blockchain has proven you don't need to know the counterparty. You just have to trust the code. And so Tether, from a net income basis, makes more money than most financial institutions. I think would be the third most profitable financial institution in the world. So what's a better bank, right? What's a better financial services model is building it on the blockchain. So I think stablecoins is the killer app that's proving, because Bitcoin anchors everything. Because you don't need a stablecoin unless you had Bitcoin. So Bitcoin and building financial services on top of stablecoins, and financial services companies are getting it now. Even Walmart and Amazon want a stablecoin because it's actually quite profitable to have one. That you are changing the financial system through crypto.
So Bitcoin's not at the top.
Yeah. So if you again model this out in utility, because remember, stablecoins is only a $250 billion market today. So you realize that stablecoins collectively are the 12th largest holder of U.S. Treasuries. They own twice as much as Germany, for instance.
Wow.
So the U.S. government does, in fact, want stablecoins to proliferate because it's a guaranteed long. Stablecoins never have declining assets of U.S. Treasury markets. And dollar dominance is only 27% in GDP terms. It's 88% in traditional financial market trading. 80%. It's 100% of the quoted pair in crypto. Dollar dominance is stronger in crypto. Stablecoin usage is only 20% in the U.S. Almost 60% of stablecoins trading takes place in Hong Kong, China, and Japan. So you can see that it's creating more demand for dollars outside the U.S.
And then therefore, Bitcoin will continue to go up?
Yeah, because Bitcoin secures the entire blockchain.
The implications of Tom Lee's thesis on Bitcoin and stablecoins extend far beyond crypto. What he's describing is the reconfiguration of financial infrastructure, where stablecoins operate not as speculative tools, but as functional banking replacements, and where Bitcoin, as the foundational settlement asset, anchors an emerging financial stack. But to fully understand why this matters, we need to look at how this digital financial system interacts with the traditional one, especially during moments of stress. Lee's research doesn't just rely on theory, it's grounded in empirical sensitivity analysis. When markets begin to reprice risk, especially in environments filled with geopolitical tension, Fed uncertainty, and recession anxiety, the key is to identify what is driving the move and whether the move is justified. According to Lee, credit markets, particularly high-yield spreads, often provide a more accurate signal than economic forecasts or equity headlines. For instance, during recent episodes of market volatility, economists were projecting a 60% plus chance of recession. Yet high-yield spreads, which would need to blow out to 800 basis points over treasuries to confirm recession-level stress, barely widened by 150 to 200 basis points. That's not a recession, it's a growth scare. This discrepancy was critical. While equity markets priced in severe downside, the S&P down 25% at one point, the credit markets never confirmed the worst-case macro scenario. That divergence allowed Lee to remain constructive even during sharp sell-offs, citing historical analogs like waterfall declines, where markets drop over 10% within a 2-week window. In nearly every case, if there was no recession, these sharp declines resolved in V-shaped recoveries. The reasoning is straightforward. Investors panic, liquidity vanishes briefly, but when the underlying economy holds, capital re-enters rapidly.
It's a lot of it is evidence-based because we do a lot of sensitivity analysis to try to understand where we are in markets. So a lot of our statements that we make are high probability statements. But for that to actually happen is luck, in a sense, right? Because something that has an 80% chance of happening doesn't prevent this being one of those 20% days that it doesn't happen. So, right, because let's see if something happens 90% of the time and it's happened a million times, but the next 3 times it doesn't happen. So like those 3 calls fail. Statistically, it's still going to stay at 90% for accumulated history. So like it is always risky to say something has a 90% chance of happening, but that's usually the reasons we make these kind of calls.
And just quickly, at a very high level. So when you're ready to say, okay, the S&P is going to jump and there's like an 80% chance that's going to happen, what signals are you pulling from? Like you said, you're looking at the sensitivities and different evidence.
Yeah. Well, a lot of times markets make big moves because of surprise. So we have to, like today, we're seeing it today with like Tesla. But the reason there's a surprise is that in a general sense, there's something that, let's say, anchors the valuation of a company. Let's say it's earnings or this S&P. Like, let's say that what anchors it is the Fed's dovish, okay? But then we worry about tariffs and recession. So, like, that's pulling down the market. You can always look for what will counter that argument of recession. And, like, for us this year, it was the high-yield market because high-yield spreads need to widen to, like, 800. The spread over treasuries has to be 800 basis points. So if the 10-year is at 4%, high yield would need to be at 12% to tell you that a recession is almost guaranteed. But high yield during the tariff turmoil only widened by 150 basis points or so, maybe 200, which is just a growth scare, if even. So the reason we stayed bullish into the April low was because high yield said the chance of recession is probably 10%, whereas the economists were saying it was 60, and we could tell by positioning and what stocks were selling off. The S&P down 25% has priced in like a 60 or 70% chance of a recession. So that's how we can kind of go on and say the market could make a full recovery because high yield is telling us there's not a recession and it's a better economist than economists. So we do have a published history of our research, so our clients can fact check us. But as the market was falling after Tariff Liberation Day, it was falling in a waterfall decline. And so we wrote very early that there have been 12 similar waterfall declines.
What's a waterfall decline?
It's a stock market that falls more than 10% within, I think we did it as a 2-week period. It's really rare to basically like literally cause a plane to drop, 10,000 feet. And almost every waterfall decline is a V-shaped bounce unless there's a recession. So that's why we got so keyed up on this high yield market, because if we fall but we don't have a recession, that just means everyone just panicked. They did a fire-ready aim. And so we argued you would have a V-shaped recovery. And a V-shaped recovery is a symmetric bounce back to the old highs. And, of course, everyone argued against it for logical reasons. They said tariffs, they're not going to be solved for a year, The Fed's not your friend. The Fed is going to – there's no liquidity coming like in 2020, so you can't have a bounce. There can't be any fiscal stimulus.
2025, no liquidity.
Well, no, in 2020, the Fed did
that's when they said it. Okay.
Fed did a lot of QE.
Right.
And they're like, there's no QE coming. But we said that history says you have a V-shaped bounce, especially if there's no recession.
Okay.
So that's what made this so hard for people to accept, because the Fed was hawkish and we still had a V-shaped bounce. I think that's the real lesson. The Fed liquidity is a myth. You don't need Fed liquidity for stocks to recover. I'd say that's really my takeaway from the bounce. And then for this week, there is an old adage that when it comes to war, you sell the buildup into war, but you buy the invasion. Right?
That's a crazy saying.
Or they say you buy when the guns fire, you know what I mean? But that's true. So we were advising our clients that you sell the buildup, but you buy the invasion. Well, so here it was our calculation, which I think maybe people would agree. The U.S. wouldn't take action if they thought it would daisy chain into a prolonged war. because there's no appetite. And Trump clearly said he doesn't want to pull us into a war. So if they're taking action, they've either signaled ahead to Iran that this is a limited action, or they know that whatever action they're taking is decisive and limited in scope. So that's why I could see why you would buy the invasion, right? And who knows? There's a lot of signs that maybe we did help indicate to Iran it's limited because, Iran had the trucks and the U.S. was aware of all these trucks moving material, but they didn't stop it. So it was sort of like, look, we don't want to topple the regime necessarily, but we're going to blow this thing up. And I don't know. I'm not a political expert. I'm just saying I can understand why we're rallying today.
But
Lee's broader message is that markets respond most violently not to data itself, but to surprises, to deviations from the consensus narrative. That's why understanding positioning, sentiment, and implied expectations matters as much as the actual numbers. It's also why he pushed back against the conventional assumption that a hawkish Fed precludes market recovery. In Lee's view, the rebound in risk assets, even amid rising rates and global uncertainty, demonstrated that Fed liquidity is not the sole driver of equity performance. Investor psychology, historical price behavior, and credit risk pricing all remain critical inputs. This framework, combining macro data, market structure, and behavioral analysis, helps explain why stablecoins and Bitcoin are gaining institutional attention. As capital searches for efficiency, transparency, and yield, stablecoins are functioning like short-duration dollar substitutes, offering low-friction transferability and attractive income streams. Tether, as Lee points out, is now among the world's most profitable financial entities, not because of leverage or complexity, but because it captures a core banking function, holding treasuries and issuing liabilities. This dynamic isn't theoretical, it's playing out in real time. Meanwhile, Bitcoin's role continues to shift, from speculative asset to strategic reserve. As stablecoins expand, their credibility and utility remain tied to the trustless base layer that Bitcoin provides. Without Bitcoin, the architecture of permissionless, collateralized digital dollars is less stable. This is why Bitcoin and stablecoins are symbiotic, and why governments and corporations are now treating them as strategic infrastructure rather than fringe experiments. Even companies like Amazon and Walmart are exploring stablecoin integrations, not for ideological reasons, but for cost, control, and settlement efficiency. For investors, the key takeaway is twofold. First, traditional macro signals, particularly credit spreads and volatility regimes, still provide high signal-to-noise ratios for gauging market risk. Second, the parallel financial system being built on crypto rails is no longer speculative. It's generating real cash flows, managing real capital, and impacting real-world dollar demand. As this convergence continues, capital allocators will need to incorporate both macro and on-chain frameworks to stay ahead. The bifurcation between crypto and the market is dissolving. What's emerging is a unified financial landscape, one where Bitcoin doesn't just coexist with traditional assets, but increasingly underwrites their evolution. Drop a comment below with your thoughts on the growing role of stablecoins, Bitcoin's long-term utility, or how you're positioning in today's macro environment. If you found value in this analysis, consider subscribing for more expert-driven breakdowns of the trends shaping global markets and digital assets. We focus on data, not drama, and aim to equip you with the frameworks needed to make better decisions in an increasingly complex financial world. And as always, thanks for watching.